All right. Good evening, everyone. Thank you for joining with us again on a Friday evening for our weekly show, Ab India Karega Invest, where every week we bring to you an interesting topic related to your investments. I am Rishabh Lunia from Novice Learning Academy. We have completed almost more than a year now since the first lockdown happened, and since then we have seen market taking a full round circle. We saw a steep dip and then recovery. Now, what are the cues for future? There are strong global cues, but there are challenges specific to our country. So what should be the strategy which every investor should follow in their portfolio? We all know diversification is the best strategy to have in these conditions. So we thought, why not talk about something which gives us the diversification in the portfolio? And hence, we have chosen very carefully the topic of today, which is flexibility of investing in multicaps. So we'll be discussing this today. And to give more insight, we will be joining with us Mr. Saurabh Arora, who is Head Digital Alliances at Aditya Birla Sun Life Mutual Fund. So we will very shortly hear from him what lies in terms of multicap for all of you. And then later in the meeting, we will be joining with Mr. Shikhar, who will take us through the Groww platform. So without wasting any time, let me quickly share my presentation, and I will start this session where I'll give you some insights on what lies in terms of multicap, and then we will hear from our guest speaker today. Okay, so the moment we think of multi-cap, immediately large cap, mid cap, small cap, everything starts popping in our head. So what we need to understand is we will quickly see the last 15 years of performance, how these three asset classes in terms of large cap, mid cap, these three verticals have done in last 15 years. Just to give you a orientation, from 2006 to 2020, 15 years data we have captured, and you could see a couple of years markets have gone down, 2008, 2011, and even in 2018 we have seen some kind of dip. So overall, broadly, if you look at, immediately the thoughts in your mind would be, oh, small cap looks fine in most of the years, okay, because the small cap bars are higher than mid and large. But this picture does not tell us the full story. So what we need to do is we need to go a little deeper into the subject to understand more in terms of each of these categories. So we further broke it down to understand year on year in terms of Nifty next 50, Nifty mid cap, and Nifty small cap year on year. So what we have taken here is the calendar year performances of all the broader indices, and these are the things which we noted. So even this was not so conclusive because there are no clear winner. So it was difficult to suggest that whether Nifty is a clear outperformer or mid cap or small cap, because different years we have seen different categories outperforming, and at times we have seen every category being underperformed also. So how do we, so we went further inside to understand little more. So we put it into the chart and trying to understand the volatility, and clearly it is noted that mid caps and small caps are more volatile. When you say volatility, when markets are doing good, you see small caps and mid caps outperforming large cap, but same is the case when markets are falling. So what do we infer from this? That large caps actually save you that downside risk, because over the years we have seen large cap as one consistent performance. So definitely we all need to have large cap in our portfolio, but can we afford to miss mid and small cap? Let's see. Now, if you see here again, what happened in last, let's say February onwards, till, so this is the market performance of all large, mid, and small during the pandemic, and then when market recovered, how these three have done during that point in time. So if you see here, it is generally when the bearish trend starts, it is seen that the mid and small caps generally tend to correct first when compared to large cap. So we have seen that even in the last February, mid caps and small caps actually started falling much when compared to large cap. And again, when the recovery happens, we see that large cap have actually, in most of the cases, I will not say that every case you will see large cap recovering first, but in most of the cases, historically, it is seen that large cap recovery starts because if you see from the concept point of view, even if every person spends, let's say 100 rupee, a good portion, 60 to 7% of their wallet share goes to large cap companies directly or indirectly. So large cap stocks remain in market action for most of the time. And that is the reason why they recover fast, because when markets went into the bear phase, they did not fall that much. So for them to recover, it is even more easier to give that good performance when markets start doing good, when the economic recovery happens. So what are the characteristics which we observed by seeing all this? We know that large cap has been really consistent, but at times they miss out on the excitement which mid cap and small cap can offer because of good economic cycle. So that is one thing where large cap can miss out. Whereas mid caps and small caps, there is no doubt they are more riskier than large cap, but at times they can give us very good return. So in nutshell, what I would trying to tell here is that we don't have a clear cut winner. We need to have all these three in our portfolio in such a way that we can take the best of it and we can give it to our investors. So what are the benefits which large, mid and small gives? If you see large companies, they work on the consistency. If you take all the big names, they've been really consistent through ups and downs of the market. So that growth consistency remains in large cap. Access to cheap funding. If you see large companies can go to capital market and raise capital at a much cost effective way when compared to mid and small companies. They even have pricing power, which they dictate in their market. Okay, at times when they are competing with others, they can actually have deep pockets, so they can bear some losses just to acquire market. And we know that the liquidity, if you're talking about stock market, liquidity is undoubtedly more when compared to mid and small in large caps. But small caps also have some advantages on their side. One, that the because of their small size, they are very, very, I would say, flexible in terms of approaching new markets. There may be innovation they want to do, and they can actually get into different market condition at a short time, which a large company may take longer time to get in. Second, they have opportunity to specialize. Now we have seen auto ancillary has been a very wide market in India, which cater to auto industry. And most of those companies are mid and small cap. So they specialize into a certain vertical which cater to the auto industry. So that opportunity is there for a small scale company. And having said that, the growth potential is limited because of the smaller base. When they get a good order or when they book a big contract, the growth is much on a higher side for a mid cap and a small cap. So these are some of the benefits which small companies offer. Now coming to how SEBI has recategorized these categories, large cap, generally we say above 80% should be invested in large cap. But having said that, they can also invest in mid and small. But again, the limitation is not more than 20%. Then there is another category called large and mid, where you can invest minimum 35 in large, you have to invest minimum 35 in mid, and balance 0 to 30% you can go into mid caps. Similarly, mid cap and small cap funds are also there, but there again your majority share goes in that specific particular cap. Whether if you are in mid cap, minimum 65 have to be invested in mid cap. Similarly with small cap. So there was a need which actually is resolved by a category called multi-cap. Multi-caps fits the bill perfectly because as per the new rule of SEBI, multi-cap needs to invest minimum 25% in all the three. So 25 in large, 25 in mid, and 25% in small. And the balance is left onto the discretion of the fund managers. So why this is such an interesting category? Uh, Purely because it gives you the advantage of all the three into one particular fund. And it is seen from my initial slides that there is no clear cut winner. So we need to have all the three in our fund, but selection of timing is very, very important. So when market is recovering fast and then there is a good outperformance, we can shift to mid and small. But when there is a bearish trend, generally large cap tends to do better than mid and small. So fund manager is at a driver's seat in this particular fund, who will take a call on your behalf. You get diversification, you get benefit of all the three market capitalization in one fund. So to know more on this, we have our guest speaker for today, Mr. Saurabh Arora, who will be taking us through in detail of multi-cap. We will be more than happy to understand from him how this particular product does. So over to you, Mr. Saurabh.
Yeah, thank you, Rishabh. Very beautifully explained the whole aspect of multi-cap as a category. So I'll just share my set of slides. Is my slide visible?
Yes, yeah. Go ahead.
Right. Thank you so much. And very good evening to all of you. And thank you so much for giving this opportunity to present to you the whole aspect of this flexibility of multi-cap. Time and again, and this is always a dilemma with all of us, that is mid-cap the best idea, or it's a small cap the best idea, or the large cap which would provide the best of stability. But always it lies that how I can get the best of all the world. That is, the power of all the three can come into my portfolio, and that's where things like multi-cap came into space. Now, time and again, we've always talked about how large cap can be part of the portfolio with added of mid cap and small cap, and that's where with all that dilemma, different sets of product which has been into existence, where most of you might have invested in the past, but SEBI came out with this clear categorization so that the investors can always get products with true to label, which in turn match their need, their requirement in the perfect way. And it can also match the agenda of being participative in all the capitalizations, all sizes of the company in the best of the ways. So what we've tried to do over here is analyze that what are the opportunities which is available across market capitalizations, why markets are set to do so well, or markets are set to recover, and why we need to participate in that way so that the customers can benefit, the consumers can benefit out of that. First, how SEBI did that categorization. So if we were to look at various sets of category from a risk perspective and the return potential perspective, the products can be stacked. The different sets of products can be stacked in this form, where large caps are one of the least risky in equity as a category. And they have in that equity as a category, they may be, that's where, because the least risk, the returns are also optimal to that. Followed by flexi caps. Now, flexi caps are a category which allow people to invest across market capitalizations. But most of the times what happens is that the money is aligned more of the basis, the index. An index typically has very large allocation, almost 65 to 70% allocation in large caps. So typically flexi caps are more akin or more aligned towards large caps with lesser allocation to mid cap and small cap. And as Rishabh talked about, that the opportunity of allocating in mid caps and small caps is definitely, that's a larger opportunity if markets are recovering and people are set to benefit much better from the returns point of view with larger allocation to mid cap and small cap, but still having the stability of large caps. That's where probably a product like a multi-cap plays a much important role or much better role in any individual's portfolio, because that helps you get the best of all the three. The large caps with a 25% minimum allocation, mid caps with a 25% minimum allocation, and same way small caps also having 25% of minimum allocation. And then rest of it can be allocated basis the discretion of the fund manager. Now, if we were to clearly define, and Rishabh also touched upon this thing in his slide, was that what exactly is large caps or mid caps or small caps? The top 100 companies in our market, from the market capitalization, from the size perspective, are large caps. Any companies beyond 100, that is from 101 to 250, are categorized among mid caps. And anything beyond 250, that is 251 to 500, are categorized among small caps. Now, each of them have their sets of benefits, have their sets of pros, and have their sets of volatility as well. And as typically many times the small caps and mid caps have much higher volatility as well. But most importantly, we need to see that within these categories, what are the opportunities? Because funds is not about just capitalization. It is about stock selection. It is about right businesses. It is about right stories. And that's where, any good fund, the whole process of it, of selecting the right stories, the right businesses, comes from the fact that how you are analyzing the economy or the opportunities in a better way. And that's where what we see from the market perspective is that what is going to be the driver of the economy? What is going to be the driver of the markets? And when I talk about drivers of the market, there are various factors. There are factors like government reforms, which is coming in. There are factors which is something like a fiscal push, which is coming. The money coming into the economy. There are factors something like a low real interest rate. And typically interest rates have always, we've seen in the past as well, that low interest rate leads to more favorable money flow into the businesses, which in turn drives the growth. There is also a huge amount of growth momentum which is being seen. Barring the fact the way the COVID has, sprung up again, but definitely there is an inherent growth which is there in the economy. There is a lot of liquidity. There is FIs as well as FDIs. All are pushing flows. And in fact, I have been hearing that FIs and FDIs are very, very favorable or very, very positive about Indian economy, and they're so favorable that why not, if international people can be favorable, we also be favorable about our economy and benefit out of that. And last but not the least is the recovery from the recession. The estimated GDP growth now, with the sluggish times what we've seen in the last year, is something looking much positive from here on, and which in turn makes us believe that probably the opportunity is expanding to a certain extent. Now, as we saw in the earlier slides as well, what we've realized that market is always a factor of how economic growth is happening. And within that, there are various ingredients. We've also seen that whenever the GDP has shown a strong growth, it is always followed by the strong growth in markets. And which in turn, in each of the components, when we talk about of large cap, that is the large size companies, or a mid-size companies, or in small cap, the small size companies, these growth is, somewhere a multiple of the growth of GDP. We've seen from the year 2004 till about 2008, when our GDP was growing at about 8.5%. In those times, typically small cap delivered almost 527% return, followed by mid caps with 315% return, and large caps about 243. A similar example we saw somewhere around between 2013-14 to about 2018, where it was all driven by 7% GDP growth, followed by astounding returns coming from mid caps, small caps, and large caps, and where mid cap was a leader. So nobody can define that this is going to be the leader and this is not going to be the leader. But definitely the relative growth matters a lot. So it is always important that we allocate our resources somewhere in every space whichever is going to deliver during the next set of growth. What is expected from here on between FY21 and 22, GDP growth is set to come up in a big way. We've seen a sluggish time last year on the back of COVID pandemic thing. Now that would give us a recovery time. And there are a lot of factors which are driving that. So it is important that we be participative of in this particular market across market capitalizations. Now, there are few sectors, few segments of market which look to be extremely attractive, and all the more between in mid-cap and small-cap space. We looked at these 5 opportunities which make us believe that these opportunities are set to be a big driver. One of the opportunity is private sector banks. Now, private sector banks, I still remember, my first bank account when I opened way 30 years back. At that time, it was only the next door bank which was the opportunity. It was not about any of the HDFCs or the ICICIs of the world. But time has changed substantially. And with that change in substantial times, what we've seen that the private sector market share of the private sector banks is growing leaps and bounds. This used to be in early 2000, which was just about 13% private sector banks had market share. Today, that is 29%. Say for instance, a bank like HDFC, which has got a participation of almost, which is the largest private sector bank in our country. Now, if that bank, their loan book is growing, automatically their returns are set to grow. And with that returns in growth over the next 15-20 years, this is going to be a big driver for our returns, for our opportunity as such. Another set of opportunity which looks to be extremely attractive to us is this government's new policy of PLI, the performance linked incentive. Earlier governments, what they used to do is they used to ask private sector to invest money in the economy. And based on their investment, they used to be benefited, or there used to be tax rebates or tax benefits given to these companies. But this time around, things have been different. What government has come out is that if you as a business is investing in India and that is giving performance of X percentage in terms of the market share, the benefit is going to be given basis that. A lot of these, Indian government actually traveled, connected with a lot of these economies like European economies and asked why do you import so much of, like for instance, mobile phones from China? And definitely the clear answer was that the cost architecture was way better as compared to India. Today, even for that matter, certain businesses like air conditioning, almost 70 to 80% of the components of our air condition is imported from China. Why can't we manufacture that thing in India itself? And that is where the thought was that the government has brought in that in every sector, maybe electronics, textile, engineering goods, automobile, pharmaceutical, in everything, this has been implemented. That more participative you are there in creating products inside and less of imports, then the benefit is going to be awarded to the companies. And that's where we see that there are almost 13 to 14 different sectors which are set to benefit out of this PLI scheme, and which would be a big driver of manufacturing in India. Specialty chemical, and which is where one of the striking thing which comes over here is in specialty chemical as a business, which is like, even something which is a raw material for a lot of our pharma companies. India has got a market share of just 2 to 3%. Huge opportunity for all of us to grow. And with that, probably that if this, overall, if this specialty chemical is set to grow, then the pharma raw material is going to will get sourced from India itself, which would be a big driver going forward. Today, we are seeing a huge digital disruption. The e-commerce of the world, the Groww app, what you're seeing, getting a $3 billion, $2 billion valuation. All these valuations talk that so much of digital disruption is happening. And all these digital disruption, the driver is our high tech or tech-oriented businesses like some of the Infosys of the world or the TCS of the world. With these companies coming into play, they are also going to be a huge driver. There are these 5 or 6 segments which are going to be driver for multi-caps, and specifically within multi-caps, the small caps and mid caps. So that's where we see that if we were to build a portfolio which is focused towards getting 15 to 20 stocks from each of these segments, mid cap, small cap, and large cap, which are high growth potential sectors, which are spread across market capitalization and which are rebalanced as well. The most important thing is that small caps may run up, but the important thing is how do we rebalance and make sure that if one segment of market runs up, the other segment is also allocated for the next run up. This product which we intend to build is more of aligned towards very high conviction ideas. The whole idea of bottom-up approach. That means selecting the right set of stocks and playing on that for a long period of time. So with that, a multi-cap portfolio gets developed. So now the biggest question comes is that, am I the right investor for this particular product? What kind of investors should look at investing in this kind of fund? So this kind of fund is something for investors who are looking at a one-stop solution, who does not want to, once look at large cap, other time look at adding mid-cap fund or a small cap, or they get confused in terms of choosing which capitalization, how much to allocate. So if you want one-stop shop, multi-cap is the category where somebody should invest. Who are aware of the risk of mid-cap and small caps as well, the volatility, what it brings, but at the same point in time, they are also aware the return opportunity which it can bring in. And most importantly, it should also which should be a good investment vehicle for getting you, the right set of SIP tool. Because as we all know, SIP is the best tool to participate in the market, to participate regularly in small intervals, at regular intervals, and in small amounts, so that, as and when we have this flow of money, we keep participating and benefiting out of the rupee cost averaging. So with that, I would, end my presentation, and I would just, take it to Rishabh to maybe take things ahead.
Thanks, Saurabh. I think really very informative, and there are a lot of, I think, those useful information which our investors would have picked up. So what we'll do is we'll straight away get into the Q&A. Shikhar actually couldn't make it. So there are a lot of questions which our viewers are sending us. And I would also request our other viewers to put your questions in the comment box, and our team will take it from there and we will discuss it with our experts. So first of all, I'll ask our speaker. There are a lot of investors who are trying to figure out the difference between the flexi cap and the multi cap now after SEBI has brought in this change. So if you can just take us quickly, like what is the difference and what investors should keep in mind while investing in them?
Right. So this is a very pertinent question, and a lot of investors have been asking about, these difference. So the most importantly is, as I said, flexi cap typically has a benchmark as BSE 200. So flexi cap has been into existence for 2 decades now, more than 2 decades. And being BSE 200 as benchmark and across the industry, what happens is the portion of large cap tends to be much higher, almost to the tune of 60 to 70%. Most fund managers would always, although the name is flexi cap, but they always try to benchmark or come closer, build portfolios closer to benchmark. And that's where, by the mandate itself, they go about allocating money almost 65 to 70% in large caps. So as an investor, if I'm investing in flexi cap and I am aware that mid cap and small cap is a bigger opportunity, so in a flexi cap, I would not tend to get that benefit of higher allocation to mid cap and small cap. So as an investor, I know the benefit of mid cap and small cap in a running economy or in an economy which is set to recover. But still, a flexi cap fund would not offer that benefit because of the sheer mandate of higher allocation to large caps. That means you would have to compromise on that extra return which can come out of mid cap and small cap if you're allocating in flexi cap, which multi caps are by the sheer mandate of being true to label, of having minimum allocation of 25% in small cap, 25% on mid cap, and 25% in large cap, and rest at the discretion of the fund manager. This allows a consumer to participate in these smaller market capitalizations, stocks which are expected to grow at a much larger pace. You can participate better, and that's where opportunity of multi-cap arises. And of course, SEBI has made it a mandatory to look at more of a structured allocation, making it true to live.
Thanks, Saurabh. I think that was really, really clear in terms of differences between flexi-cap and multi-cap. Now, IPOs and NFOs have been always the driving factor, especially into investors. So I think one of the investors wanted to know if Aditya Birla is planning any NFO on multi-cap. Is there any plans? Yeah.
Yes, in fact, post categorization, this was one of the things across industry that these are the sets of products which needs to be brought in. And I'm happy to announce that, we are one of the first fund house to bring in a NFO on these lines. In fact, we've just started the NFO, and that's going to, in fact, that'll end around 3rd of May. That is set to end. It's just started from 19th of this thing, and that is available on Groww app. You can very well go on Groww app and look for this product called Multicap, and this NFO is also an opportunity for you to look at allocating across market capitalizations.
Oh, so that's a great opportunity for all the investors. So
yes.
I think it's already on, and it is, as Mr. Saurabh mentioned, it will be there for the first week of May. Okay, another investor wanted to know, I think you also showed in your charts that when economic recovery happens, mid caps and small caps tend to do better. So is there any logical reasoning behind that, so that investors can keep that in mind? Why this happens? Because it's not by chance. Every time we see this, it happens. So what is the main driving factor behind that?
Right. See, when we invest in any stock, the stock, ultimately, that is a business. Now, that business, the driver of that business or the driver of a stock price is the earnings. Ultimately, we always say that stock price is the slave of earnings. So any stock to do very well, may it be a mid cap or a small cap or large cap across markets, if the stock, that company, that business is doing well, that is their earnings are growing, that stock will set to follow. Now, how would earnings grow? Earnings would grow because of the factor as that economy is doing well. If an economy starts doing well, there is better money flow which is available in that economy, which in turn makes sure that the products and services which those businesses are selling, that gets sold more. So the clear factor, if economy is doing well, businesses and services would be able to sell more. If they sell more, their earnings would grow. And if their earnings grows, automatically the stock price would tend to follow. That is the simple philosophy of stock market forever and ever. And that happens out here as well.
That's great. So it's a virtuous cycle. I think when companies tend to do good, they actually give more income in the hands of their employees, which actually go out and spend. So that way, the economic recovery takes place. Well said, Saurabh. Um, now, there are questions with the people are also having doubts that because of COVID's markets are not very stable. So is this a ideal time to get into mid caps and small caps, or better they invest in a large cap? So why a multi cap makes sense at these times?
As I started at the beginning of my presentation as well, and this thing, uh, there is a huge amount of difference between last year versus this year. We as an economy uh, have been going through a lot of transition. There is ample amount of money flow which is there in the economy. There is huge amount of inherent growth drivers which are there in the economy. Unlike last year also, when the COVID hit us, and that hit us with surprise. This time around, the second wave has also been a bit of surprise, but we are better equipped. We are better in a better position to handle this situation. It was completely unknown at that time, versus now it is unknown known state which we are into. We have visibility of the vaccines. We have visibility of overall businesses as well. And it is not a situation which is completely, of course, a lot of people, when we hear news, it shows completely out of control situation, but still from an economic point of view, we are still much under control as an economy, and there are a lot of growth drivers which are available. Simple thing is that last year when this thing hit us, we didn't had even PPE kits. Today we produce PPE kits not just for us but also for the world, right? So this is the huge amount of difference. At that time, we were worried whether we'll be able to make our own vaccine. Today, the whole vaccine which is being which is being consumed in our country is the vaccine of are produced all in India. So the visibility for us in the economy is much better, and with that visibility, the markets are also going to follow. And that's the reason, if you see, the last time when markets had fallen, it was a crash, an unbelievable crash. Now it is more of a correction. And there is a difference between crash and correction. And when we look at corrections as of now, it is a very healthy correction, with the markets looking upwards as well, which in turn is going to be the driver. And most importantly, the GDP growth, as I talked about, is the key factor for us to look positive for this market.
Great. So I think the trend is upward. So a lot of positive cues. Yes. So it is an opportunity for all the investors to take advantage of these corrections. Okay. Another question, I think, where the investor is asking, should I stop my SIP and as markets are down? So I would just want to say that, first of all, we don't know. Only when we see backwards, we get to know whether markets were high or up. At the moment, first, we don't know where we are. Secondly, even if you feel that markets have corrected and markets are down, actually SIP is meant for those times, because it will help you to accumulate more number of units. So if you are a SIP investor, in a hindsight, you should be happy that you're getting an opportunity to actually average your pricing. So there is no point of stopping SIP, because if you are stopping, then the whole concept of SIP will go for a toss. So please don't go and stop your SIP. Rather, if you have more disposable income, try to take opportunities. If you feel that you are getting good valuation, you can use that as an opportunity to invest more in these market conditions. Now, a generic question, Saurabh, what are the basic criteria which are invested? Because every week there are a lot of new investors who join us as our viewers, and they have these clear doubts because there are so many mutual fund schemes available. So how do they select best schemes? What are those 3-4 things, key things they need to keep in mind while selecting any schemes from the available lot?
Uh, in fact, for me, over this last 2 decades, I started investing in 2001, and and in fact, incidentally, I started investing in 2001 from my first salary through a SIP, and from that time till now, this thing has always come into my mind, that how to communicate to even my friends, that what is the right criteria. One thing which I have followed, I would like to share with all of you, is most important thing is, while looking at a portfolio, while looking at my investment, the most important thing I look at, what is the kind of pedigree, what is the kind of name which is there I am investing. Brands do matter a lot. The history of those fund houses are more important. Individual funds may perform good or bad. It may have a last 1 year of great performance, or last 3 years of great performance, or it may not have. But the good fund houses tend to reach to your goal in the best possible way. Number two is, you are participating in the market. So most important thing is, if you're choosing an equity fund, you're participating in the equity market. If you're choosing a fixed income fund, you're participating in the fixed income market. Most important thing there comes is that, how am I choosing the right kind of product? Whether it has to be a multi-cap fund, it has to be a flexi cap fund, it has to be the large cap fund. That's the second set of criteria that I should be looking at, and how much I am allocating to that category. Number three is, definitely it comes is that, whether I should be diversifying myself across categories. Not look at one kind of category, but spread myself across, so that I have taste of all the sides of the market, and I should not miss out on any opportunity. Last but not the least comes is, how that fund over a long period of time, over a period of 5 year or a 7 year period, have that fund in that category has done, and that kind of return does it meet my overall goal of returns. One thing which I always say, that it is also important to choose the right set of asset allocation as well. I should not be looking at what funds have given the best of return, but whether all the kinds of products are there in my portfolio. I am investing in large caps, or I am investing in equity, or equally I am investing in fixed income as well. Because asset allocation plays a much larger role than finding the best fund or the best return as such.
Great. I think very, very well directed. So as Saurabh mentioned, asset allocation is very, very important. And as we have covered in few of our previous shows, that how asset allocation is key, because if you invested in the best of funds, but if you couldn't get the asset allocation right, it will not add any value to your portfolio. So well said. And having said that, getting the pedigree right, looking at the consistency are other two factors which Saurabh mentioned, which you need to keep in mind while selecting funds. So I think that was really useful. One last question. I think, again, it's a very generic question, like for investing into mid caps or small caps, SIP or lump sum, what do you suggest? I know it's dependent on the goals, but any other views which you would like to add?
No, see, it also has two factors. One, I have available funds. I have lump sum available funds with that. Even if I keep it in my bank account, I'm not going to add too much of value to my investment, right? So participating in the market is important. SIP is by far, it's one of the best tools. There is proven science over this last 30 years of mutual fund industry, what I've seen, that SIP is definitely the best tool to participate in the market. But the aspect of lump sum also cannot be negated, because of the sheer fact that I have to participate. I have to keep my money busy. I have to keep my money, keep it earning as such. If that has to happen, I have to keep myself invested. But if I'm not confident of the market at this juncture, there is another tool which is available, which is called systematic transfer plan. That means I allocate my money into a fixed income investment, and and slowly and steadily I make my money move into equity by way of in a SIP form, but in bit by bit. So I invest 1 lakh rupees and make 8,000 rupees systematic transfer into equity, and ultimately it reaches to equity, but I get the benefit of rupee cost averaging as such out of this same route. But definitely, if you have, as we say, the markets are looking to be very good from here on. Markets are set to recover much better. Definitely, lump sum also looks to be good. Maybe we can break our investment into 2-3 parts and allocate money over the next couple of months period.
Great. So as they say, timing the market is not important. Time in the market is important. So as Saurabh mentioned, SIP has been an evergreen concept. But if you have lump sum money, you break it down into few tranches so that you are not taking the risk all at a time. So I think that was great, Saurabh. I think you answered I think very clearly, very simply, and I think a lot of our new viewers would have definitely benefited with this show. So I think with that, we come to an end of today's program. Thank you so much, Mr. Saurabh, for joining with us and giving a good insight on multi-cap funds and in generic to the overall economy. So thank you so much. And with this, we wrap up today's show, and we will catch you with all of you next week again on a Friday. Till then, stay safe, stay healthy. Thank you.
Thank you so much, Rishabh. And thank you, Groww, for giving this opportunity to share my views.
Thank you.